Hello and a very warm welcome to you. I'm Natalie MacDonald and you're watching Sydney Direct. My guest for today, Julius Garofali of Stockbroking here in Sydney, is going to be talking to us today about the market year ahead, the downsides and what his stock picks are for 2015. Julius Garofali, Happy New Year to you. Thank you very much for joining us today.
You're welcome. Happy New Year, Natalie.
Okay, so firstly, what is your view on the markets for the year ahead?
Okay, for the Australian market, I think if the US market, the S&P 500 can hold up and maintain upward trend, I think we'll be okay. A lot of economists, a lot of market participants are looking at the Fed hiking interest rates. As long as the Fed can do that in a timely and orderly manner, I think global markets can even sustain the current upward trend. I don't expect too much upside. Our personal target would be 5-10% upside in global markets, and I think that compilation of most economists have about 2.2% economic growth coming out of the States for 2015, and I think if that can be achieved, you have a robust US economy. Means that's the engine to corporate profit growth. Outside of the US. We've seen China, even just on Monday, they announced a $1 trillion infrastructure investment spend to boost economic growth among, I think it was 300 different projects among 7 different industries. I think from memory it was health, clean energy, oil and gas, transport, and infrastructure projects in general. Besides that, late November you would have seen that China, for the first time in 2 years, cut interest rates, and that's a sign that's going to stimulate the economy there as well. Couple that with Mario Draghi's announcement, the president of the ECB. He announced, he said, "I will do everything in my power to generate inflation in Europe." So that just means more stimulus and lower interest rates for longer.
What are your 2 best stock picks then of 2015?
My 2 best stock picks are Bank of Queensland and Macquarie Bank. Just on Bank of Queensland, I'd have to say it's Australia's best kept secret. It's a small regional bank based out of Queensland, and what we've witnessed in Queensland in the economy, that as a result of the falling Australian dollar down to the low 80s, it's actually really benefiting that side of the economy. Tourism's going up. Housing prices are stabilising, and small to medium enterprises do very well, and they're the bank behind it. Market share is growing for the bank. They're well capitalised, well provisioned. Bad and doubtful debts are falling with the bank, and also they've had 2 credit upgrades, which increase margin expansion for the bank. Look, they're very cheap. They're on 12 times P for 2015. The yield is quite well, just shy of 6%, fully franked. Their 12-year average P is about 13.2 times, and I think that the bank trading on 12 times doesn't make much sense. I think that we're going to see re-rating in the stock. I think that what's been holding them back really is the market's focus on more large cap banks out of our top 4 and neglecting the regionals. So there's Bank of Queensland and Bendigo, other regionals. Bank of Queensland just this week announced the full-time new CEO, so there shouldn't be any concerns about not having a CEO leadership. So that's all done now. You're finding that the regionals are very well capitalised. There was a new financial system inquiry in Australia recently that only affects the top 4 banks, not the regionals. The regional banks in Australia are actually the highest capitalised banks in the world, and I think that's very important when looking for investment in Bank of Queensland. If Bank of Queensland were to trade on their long-term P of 13.2 times, that would actually translate to $13 for the stock. They're currently trading just under $12. So I think there's good capital upside, good strong dividend yield. I would have to see 12-15% upside in that stock for the next 12 months. That's my number 1 pick. My number 2 pick is Macquarie Bank. I've said it in our previous interview with the M&A cycle turning around nicely. We've seen a whole tranche of deal flow going through over the past 12 months. Macquarie Bank in the paper announced on Tuesday said that they are the number 1 in IPOs, number 1, which means ahead of UBS, ahead of Goldman Sachs, they did 16 IPOs last year, averaged about $4.2 billion. So it's good to see Australian companies taking a preference from Macquarie. We're quite patriotic in that way. Again, look, the bank is cheap. They're yielding about 5%. They're trading on about 13 times. Again, that's discount to the long-term average. Now, 60 to 70% of their earnings is offshore. Pre-GFC, I think about 30% was offshore. So you're getting that US dollar exposure with the bank. Most economists, most market strategists are expecting a good, robust M&A cycle, more IPOs to flow through this year. And I think that will really benefit the bank. I see a good 10-15% upside in that stock pick.
We've spoken a little bit about market conditions for the year, and one of those is that low interest rate environment. Given that, is 2015 the year to begin investing or adding to equity investment?
I would say both, Natalie. Look, the RBA outlook is to keep interest rates low for longer. We're not expecting a rate hike this year. Several brokers are actually calling a rate cut. It just makes equity investments more enticing, more attractive. I'd have to say that you can barely get 2.5%, even 3% on term deposits, and we're seeing rollovers of those existing term deposits that are expiring. Rollovers are becoming less frequent. Getting a lot of calls upstairs to preference for equity investments. People calling up buying shares. Medibank being such a successful float late last year has really made the average household quite happy to invest in shares once again. The risk has really left the market in contrast to 5 years ago. So a lot of clients actually like our top 20 blue chip stocks. Anything yielding 5-6% fully franked is fantastic. I really like 2 ETFs that I've been buying for a lot of clients. One of them is called YMAX, the code. It's the Equity Yield Maximizer, top 20 blue chip stocks. That fund sells call options to get extra premium. They're yielding 9% partially franked, so grossed up's about 12%. Mums and dads loves that stuff. There's another income fund, buy beta shares as well, called Harvest, code HVST. Buying those as well, they're yielding 16%. Grossed up yield will be 19%. So that particular fund, what they do, they hop from different groups of stocks throughout the year and gather the dividends from those top blue chip shares in the top 100 index. They short the SPY to reduce volatility in their fund, and that fund actually pays monthly. So you're getting 16% and paid monthly. Not a bad ETF. So a lot of people prefer that than getting 2.5-3% return on money on deposits before tax.
Julius, thank you so much for your comments today. We look forward to catching up with you again soon. Thank you.
You're welcome.
We'll be back with plenty more exclusive interviews and FX analysis. But for now, it is goodbye from me.